The new year is off to a rough start, with the Mag 7 complex taking quite a beating on Friday. The proxy ETF was down over 1.5%. But it's not even just the percentage change that's worrisome, no. It's the fact that most Mag 7s tried to break out, but they just failed miserably. However, there were at least some themes that had relative strength on Friday, which keeps me thinking about rotation for the S&P 500, not an outright bearish collapse. Just like we ended 25, 26, even though we're just one day in, continues to look like a picker's market and not a passive market. So welcome back to the Trade Brigade Weekend Show, where we'll take a look through all of the data points and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 7 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off on the SPY monthly timescale, talking about candle structure and location as we always do now that December bars have officially closed out. In terms of candle structure, second bar in here, we've got ourselves a green-bodied indecisive doji, which would imply that the candle close is technically over the opening print, but it's a small-bodied bar. We know that the defining characteristic traits of an indecisive doji are really the large upper wick and the larger lower wick. And what they would imply is that buyers could not find price acceptance near the range high, and sellers also couldn't find acceptance near the range low. So it leaves us with a little bit more of a neutral stance when it comes to candle structure here, maybe slightly more bullish than bearish because of the green-bodied bar. But let's look no further than candle location on the bar-to-bar count. Notice that we do have a break of November's high, giving a higher high on the bar-to-bar. But where do we close? Right back inside of November's range. So that's a fairly unsuccessful breakout. We did not find range expansion. That's technically slightly more bearish. But we can't just look at highs, we should also look at lows. In terms of bar-to-bar lows, it's a substantial higher low. So on the bar-to-bar analysis, everything really points towards more neutrality. Now the question I would pose here after going through that is it reasonable that the market could cool off? Of course it is. I mean, off of the April tariff lows, we're up something like north of 40%, right? If we do something like this to the all-time high, the move there is about 43.74%. Is it reasonable that the market could cool off? Of course it is. And is there anything else on the screen that looks similar? Of course. It's this rally right through here, which led to a monthly equilibrium. And I'm not suggesting that we need to experience a tariff-induced volatile pullback, but let's just play this out for a second. What's the major monthly trend? Is it up? Is it down? Of course it's up. We have lows, higher lows, higher lows. We have highs. Let's say we have higher highs, and of course we're sitting on the highest high of the trend count. So if the market pulls back, is it reasonable that coming from the highest high, we could afford to set a monthly higher low and keep the trend up? The answer to me is absolutely yes. Let's ask the next question. What would be the most obvious place for this to take place? Right? Of course, it's going to be your previous all-time high. If we can use previous resistance as newfound support with confluence of the monthly 20 SMA, is this not a great spot for a monthly higher low and trend continuation on the higher time frame? And it's better than just the monthly 20 SMA. Let's get a little crazy here. Let's break out a Fibonacci from not just the 2022 low. We'll do this one because why not, right? This would be happening over a Fib 38.2, which is technically bullish. But let's also come in from the April tariff lows up to the all-time high. And if you've been watching the channel for a while now, you know that the Fibonacci 38.2 is right at that prior high. So this 610, 612 zone on the monthly timescale would be an awesome spot for a monthly higher low. What else is pretty compelling about this? Well, statisticians, that's what we want to call them, the stats fellas would tell you that on average, the market might experience one 10% pullback intra-year, right? Doesn't mean the market's going to be down 10%, but intra-year you might experience about a 10% correction. Well, if we bring back out that measuring stick from the highs down to this low, suggesting that that might be the higher low. Let's clear up the drawings. There we go. You can see that that is roughly 11.5%, 12%. Is that in line with what would be normal intra-year for any given, year? I think yes. So a lot of stuff aligns here on the monthly timescale for a higher low opportunity around this 610, 612 zone if the market pulls back. Now, this is what I want to get into next. I'm not suggesting that the market needs to go here. This is just a back pocket analysis to say, that's a tongue twister, that if we need to build a base case, and if the market starts to break down from a weekly equilibrium, which we'll take a look at in just a moment, I would not change my higher time frame bias as and if we pull back into 610, 612. It's a great spot for a monthly higher low. So the next question might be, okay, well then what will make you change your higher time frame bias? If we pull back, set an equal high, and break what would then look like a double top neckline on the monthly time scale, I'm running for the hills. And why could I say that with any degree of confidence? Well, every single time we get a monthly close, we study the monthly tops of the dot-com bubble bursting and the great financial crisis. What do we see here? Monthly double top. There it is. Here's your lower low. Here's your lower high. Underneath the monthly 20 SMA, mind you, wave 1, wave 2. What do we classically say? The monthly trend needs to be down if really bad things are going to take place in the market. If we get a monthly double top and a trend reversal, I will change my tone and I will change it ASAP when and if that happens. You can see the same exact thing. It's even worse, of course, but it's the same exact thing. Monthly double top, 1, 2. Here's your neckline. Here's your lower low. Here's your lower high under the 20 SMA. Even get a second chance lower high to bail underneath the monthly 50 SMA. Then really bad things happen in the market. Does the market look anything close to that as of right now? Of course not. Right? So the base case, once again, not a suggestion that we need to pull back here in the month of January or even February, but if the monthly charts pull back into the first half, let's even say, of 2026, it's not the end of the world for the index. And I would also offer the idea that the market's been very structured over the last 5 years, very, very respectful of structure, right? Previous highs act as support roughly in the 2022 pullback. This one's even more precise. Previous highs act as support at the very bottom of the April tariff-induced volatility Armageddon. So is it unreasonable that we could look to, as a base case, previous resistance potentially acting as newfound support for a monthly higher low around that 610, 612? I think all of the pieces of the puzzle really align with that, once again, being the base case if the market pulls back. The other alternative is just that you remain in a consolidation phase and we break it in the upward direction. So what might be a target to the upside if this market's going to continue? Well, I did the exercise of taking a look at the yearly expected move for 2026. The upper bound is roughly 784. Once again, it's not a suggestion that the market needs to go here this year, but it is what the options market is at least pricing in terms of a 1 standard deviation move as of December's close. If we pencil on down to, let's go to the weekly chart, and we'll talk candle structure and location in just a second, but I do want to talk about the January expected move from the options market. It's right here. What is 660? It's not even a breakdown of this equilibrium low from the weekly balance, right? We know that this weekly balance has been in play for a little while now. 660, the January expected move low, is not even a violation of that level. And once again, this is a suggestion from the options market. It doesn't mean that 660 needs to hold for January, but based on the odds, based on the data that we do have in hand, it doesn't seem overly aggressive. So let's take this off. Let's take a peek at a clean set. Let's auto zoom this. Let's get ourselves situated for our normal analysis of the weekly now. In terms of candle structure, what do we see here? It's a red-bodied hammer-esque bar. I really wouldn't even classify it as a hammer. This is much more of a hammer here. But this candle is just a small-bodied compression of range. I don't think that the structure is overly compelling for the bulls or the bears. If we think about candle location on the bar-to-bar count, certainly a lower high as well as a lower low, and just a close back inside of the previous week's range. This is totally just compression of range at the top end of what I would consider, once again, a weekly equilibrium. You're not really in a weekly downtrend. I wouldn't quite call this a failed breakout yet. You do technically have lows, soft higher lows. Daily trend wasn't really down there. Is this possibly another soft higher low? As we'll see on the daily chart, I think that there's a compelling reason to think so as to why. NASDAQ's coming into support. S&P is trying its hardest to reclaim that daily 20 SMA, and we are seeing a rotating market. We're not necessarily seeing everything all red all at once. Take a look at the sectors. We'll get into a deeper analysis over there as we move through today's video, but for now, the weekly chart does not seem like an Armageddon situation, and as a matter of fact, you could probably strike a trend line here and just say something along the lines of we're holding trend line support. If we wedge in here and break to the upside, once again, a range double would probably be the more bullish outcome into the early stages of 2026. If we move to the midpoint of the range, I would still be open-minded to some potential higher low or equal low around this 20 SMA on the weekly timescale, just remembering once again that the daily trend did not flip to down to set this low in here. So if the daily trend does flip to down and we do make it into this low, then maybe it's a possible firm weekly higher low from here to here at that point, confluence with that 20. But let's take a look through some additional supporting evidence. We already covered the Fibonacci's on the monthly. Let's go to our anchored view apps. I just want to point out that we're above the entirety of the stack, right? Although, yes, oh my goodness, it was so bearish on Friday. It really wasn't all that bad. The weekly bar didn't come anywhere close to dipping a toe into its anchored view app stack in here. We'll throw the fibs on just as a reminder. Again, if you come from the April lows up to the highs, highs, extend this to the left. There's your confluence around that 610 area, 612 area. We could also come in with a fib from the range low, the equilibrium low, up to the top end. And if I just zoom in a little bit further once again, notice that this consolidation, this range compression is happening over a fib 38.2. It really doesn't strike me as being overwhelmingly bearish. And again, we'll give the sellers maybe a little bit of credit where credit is due. A look above and fail is kind of underway a little bit, but it's not enough to make me bearish on the market overall. It's just a little bit of a headwind and the lack of momentum in this market, in my view, that is preventing a smoother sailing, I guess you'd just say momentum-driven move in the upward direction. Anyhow, let's take a peek over at our volume profile. And as we look at this, where's the weekly? There it is. Too many studies these days. I got to clean that list up. If we take a look over here, where did the market land relative to this high volume node? We closed right on it. So once again, if this was going to be a detrimental Armageddon, oh my God, 26 is going to be the end of the world, you probably should have closed underneath that. And then, of course, the next big break is underneath this, which would be confluence of that weekly 20 SMA, prior high volume node here, thin volume void rotation. And that's maybe how the monthly trend develops, as a pullback. If we get this weekly equilibrium breakdown, that's probably what allows the market to move for that monthly high or low. But let's take this one step at a time. Based on everything we've seen thus far on the weekly time scale, this is not a showstopper of a weekly bar. Let's get on down to the daily time scale, and let's firstly evaluate this week's expected move. It is slightly compressed, in my view, relative to what it more appropriately should be. We did get quite a bit of volatility relative to prior sessions on both the Wednesday and then Friday session, but let's just take it at face value. Here's the expected move for the week based on the options market. If you're not familiar with the expected move, check out the video tutorial in the top right-hand corner. There we go. Top upper corner? Sure. We've got 691s as the highest high of the trend count, as well as the upper bound of the weekly expected move. The bottom end of the weekly expected move is around 674.75. That's a slightly higher low relative to this low from back over here, the massive overshoot of the key higher low zone, the thesis that we had into the early and mid stages of December. So I'm all right with that around 675. To me, this is much more of an equilibrium expectation rather than a bullish or bearish expectation here. You can certainly see that, again, on the weekly chart, we saw those side-to-side bars. On the daily, you could just see how the market's gone nowhere, right? It's really failed to break lower here, and it's failed to break higher here. So as we remain in the midpoint of this equilibrium, I don't really think that there's much compelling here on the daily timescale to say, other than, okay, you have lows, you have higher lows. This is potentially a higher low over the daily 50 SMA, but where the market probably gets free and clear is if we can produce consolidation over the previous all-time high shelf around 689s. If we could break out over that, that's probably where we have a bit more of a compelling look to the upside if the market can catch a momentum bid. And we would likely need to see many more components starting to participate, aka the tech sector, and not just rotation into financials and select little, like for example, the SpaceTheme has been hot recently. We'll get into all this stuff. Some clean energy themes, drones, that stuff has really been what's keeping this market rotating, right? So if financials and tech can both participate along with some of those more selective themes, the speculative themes, then great. We probably have a momentum market on our hands. If we don't get broad-based participation, I would expect more neutrality and sideways consolidation in this zone until we have some sort of catalyst. Now, what do we know is a potential catalyst into the coming week's worth of trade? The labor data. And we'll talk more about the economic calendar in just a moment. But on the Wednesday session, we get our first taste with the ADP non-farm as well as JOLTS. So that, outside of a rotating market, could be the next spark to get something going here. So in terms of the bottom line on the daily timescale, expected move, neutral, in this box right here. I think I butchered saying what the top end was, so I'll say it one more time. It's about 691.56, and the bottom end is at 674.75. If that can hold, it's neutral, it's consolidation, it's not the end of the world. If we can break out of the weekly expected move, that's where I think this market gets a little bit more interesting. Let's drop it on down to the hourly timescale and start to build a game plan for our actual pathing ideas this upcoming week. So this consolidation was fairly bullish, breaking down into that Wednesday, and then of course on Friday, large rout right out of the gates. That drifts us into an hourly downtrend. There's no sort of way around that, right? You have highs, lower highs, lows, lower lows, and of course now lower lows. So the hourly trend is down. But are we at a decent spot for a potential higher low on the daily? I think the answer is yes. It's the neckline retest of the inverted head and shoulders. We talked about the daily 50 SMA just a moment ago on the daily time frame as well. So if the market can produce an hourly or an hourly double bottom reversal or some sort of, let's say, overshoot and just a mirror image of this, basically, just drop that right here. If we can get inverted head and shoulders, some kind of hourly trend reversal, that would be where we want to get bullish. And what do we try to do? We try to target the range high, and then once again, the bull thesis from the daily chart probably steps up on some sort of hold over 689, and then a potential break over the all-time high here around that 691 spot, right? 691.90, what is it? 691.85, 65? 691.65, we'll say. So that upside break there is the potential reversal for bulls. If it's going to be a bit more bearish, I would sort of align with the idea consolidation here is not really so helpful. You've lost the daily 20, you've lost the 50 at that point. Then, of course, Brigade bolts underneath 675 get a little bit more dangerous. You're probably talking about a retracement towards the 668.50 as, you could then start to say double top on the daily under the neckline. You're going at least to this low, but more importantly, that low here. If we just zoom back out on the hourly, you could see why this is all thin structure retracement, thin structure retracement. The next major structure is coming from that 686.50. So that's the way I'm seeing the market currently. It's a lot of wait and see, honestly, inside of this box right here. I'm not compelled to be overly bearish because of the rotation and supporting evidence that we're about to get into, as well as the higher time frame narrative. However, I do have some lines in the sand, right? And inherently, it would just be this. If we start to get bear flag consolidation, that's a warning shot. If we break this, that of course is much more concerning, and the bears are starting to come out of the woodwork. So about 679.75 and 675 are the major spots to watch into this coming week's worth of trade. But for now, I'd say that a majority of the analysis kind of points to neutrality up here and digestion of the April tariff rally, if you will. And on the daily timescale, it's just an ascending triangle, right? How is it not? Let's come in here with a little bit of this. Let's come in here with a little bit of this. There's your ascending triangle. Yes, failed breakout. We've acknowledged that, I think, fairly. But until you actually break down and change the daily trend to down, I would be looking for pullback longs. I would be looking for equilibrium and just let the balance take place. I would not be an aggressive short, basically, is what I'm trying to say. I would really not even be an aggressive long until we start to get that acceptance up and over 689, threatening and pressuring the breakout into blue sky territories. Why not? Well, just because, as we've seen, there's not really momentum in this market. So if you're starting to get jammed in here long, I mean, swing longs, fine, but intraday momentum-driven breakout longs, not really paying the bills over the last 3 months here. Let's go back to the hourly chart, and I do just want to drop in here the intraday anchored VWAPs just to point out we're in the middle of the cluster, right? This cluster in here is not all that helpful. You've got these barreling down on top of us from the all-time high as well as the gap up into the Christmas week. You could see if we were to rally and stage a lower high there, the hourly trend will remain down. If we break this anchored VWAP, that is anchored to the very bottom of this overshoot from back over here. If we fail that, once again, this is bearish consolidation and why I would be more open-minded to a Brigade bolt under 675, really staging the next move, being underneath all of the major reference points there. Let's take a look over at the market internals first and then profile. If you're not familiar with the internals, check out the video tutorial in the top right-hand corner. But what does this paint a picture of? And what I really want to focus on and emphasize here in today's analysis is Friday was a fairly aggressive intraday trend to the downside, right? We just talked about how on the weekly chart, the daily chart, it's really not that bad, but intraday, yeah, there was some substantial selling pressure there. However, what's going on at the exchange level? Volume flows are technically in. The advanced decline line is technically up. Yes, the index score is down because it measures from the opening print, but look at the tick over here. Nice build in the upward direction. Not enough to be substantial. It's just shy of 5,000. But the point of the exercise is to say, just looking at the internals dashboard here, it's like the concentration in the Mag 7 dragged the market lower. However, the broad cohort of the NYSE really didn't perform all that poorly. It looks pretty darn good, as a matter of fact. You got pretty close to trend higher zone here. You got pretty close to trend higher zone here, and you built out a positive cumulative. Outside of the Mag 7, not a bad day for the markets on that Friday session. Let's go on over to the market profile and see if we can parse out any additional information. We do have a poor high at the A and B period right up here. And again, if you're not familiar with profile, check out the video tutorial top right-hand corner. I'm yet to read the feedback comments from last video, so if you left one and you said, hey, stop doing this pointer stuff, that's on my to-do list this weekend, and we'll implement that from here on out into 2026. I'm so thankful for all of you who leave comments on, constructive feedback, have reached out via email, the whole 9 yards. I really appreciate it all. On my to-do list this weekend, we'll implement it going into 26. In terms of the market profile structure, though, poor high A and B periods at the high of day from Friday does need a little bit of repair. Notice also it's not perfect, but it starts to get a little bit mechanical at the value area high from the Wednesday session as well. Value is undoubtedly shifting in the downward direction, but notice that the point of control does not close weak on the lows. It's more so centered in the profile from Friday. You have a better excess low as compared to the high. Notice the I period sticking out down at the bottom. Those single prints would indicate that the auction ended properly towards the bottom, which is a healthy sign of a bottom. bottom. Let's see, like, an example here would be into early stages this upcoming week, does the market find acceptance over value area high, and can we rotate up to repair the poor high, which would start to kick off what? We'd just be back up towards the top end of the range that we were talking about on the SPY daily, right? This range from right over here. So that would look something like this. Acceptance above, break up and over 686 on the spider's cash, and you're talking about 689 as a potential target, right? So that's kind of what I'm seeing here in the market. Once again, it's not really a bearish tape. I mean, intraday, yes, downtrend, but overall, is the supporting evidence pointing for a massive market correction? I don't really see it, and we'll get into more of that as we go through today's analysis. But before we do so, let's jump into the Qs, the NASDAQ side of this equation here. Let's kick this up to a monthly. Let's quickly turn this on. Let's turn that off. And let's turn this on as well. We just want some simple moving averages, maybe a clean drawing set. Perfect. So this is the SPY. We want the Qs, but we still want that clean drawing set. There we go. That's looking good. So it's the same analysis, but slightly different. In terms of the candle structure on the monthly, it's absolutely an indecisive doji, very similar to that of the S&P 500, probably even more indecisive. Notice the complete lack of candle body. You'll also notice that December does not break over the November highs, and it is just an inside candle with a close right in the midpoint of the November range. It really leaves a lot to be desired. And once again, is this reasonable after a monster rally off of the April tariff lows? I think the answer is absolutely. So some consolidation here is well within the realm of reasonable outcomes. It does not strike me as being overly bearish. It doesn't look like we're crashing from a double top rejection pattern, a failure, none of that. If the NASDAQ pulls back, just like the S&P 500, this would be a pullback from the highest high in the trend count, and therefore a potential higher low over something like 535. The monthly 20 SMA here is looking a-okay for a higher low and trend continuation. Like the S&P, if we drift into a monthly downtrend via some sort of rejection, let's call it a double top, just to use the same blueprint as the dot-com bubble and the Great Financial Crisis, if that takes place, then fine, but it just hasn't taken place yet, and the base case analysis is such that we are looking for a higher low. Let's come in with the Fibonacci's same reference points as the S&P from the 22 lows up to the highs. That would be over the Fib 38.2 there, and if we come in from this low up to this high, we know it's right on par with the Fib 38.2 from that perspective. If we come in from the highs and take a look at what the pullback depth would be, it's right along the lines of that 10%, 12% correction, which may happen about once on any given trading year. Intraday drawdown, or sorry, not intraday, intra-year drawdown. It doesn't mean the market's going to close down 10%. Once again, I want to be very clear about that so nobody misunderstands, that I'm expecting a 10% down year. No, that's not the case. Just intra-year volatility could be along those lines. If you take a look at the structure of the NASDAQ, it's been much, much wider than that of the S&P, but you could see previous highs acting as loose support, previous highs acting as April tariff support. Once again, I think the market's been very well structured, very well mannered of you, nasty NASDAQ, here on the monthly timescale for that potential higher low if the market pulls back. Again, not a forecast that we have to pull back, but the base case is such that if we find ourselves there, I will maintain a bullish stance looking for a higher low opportunity on the higher time frames. I think I've pretty much exhausted that thesis across now these monthly charts. So let's get on down to the weeklies for the NASDAQ and see what we have over here. We know that the equilibrium is absolutely in play via this range compression. The weekly bar is slightly weaker than that of the S&P. It's got a little bit more of that red close on the low end instead of the lower wick. But again, it's still in this compressed range. It's very difficult to make an assessment of trend when there is no trend. So very simply put, on the weekly chart, if we can break up and over these highs, great, we are bullish. And I would maintain the stance that over 628, bulls on parade looking for upside into 26. If we take out the 20 SMA on the weekly, I don't know that I throw in the towel all the way, but I start getting fairly concerned about a potential weekly low sweep underneath this area in here. Those equilibrium lows are closer to about 588, 587. If we take that out, now all of a sudden you're talking about weekly double top, weekly trend flips to down, and I would think that's kind of what kicks off, as we said about the S&P, the pullback into the top end of these prior highs, now potentially acting as support. We could bring in all the fibs, do the whole 9 yards, just like we did in the S&P. That's cool. We can come from here to here. Fib 38.2, as we know, we could come in from the gap up, the deal to make a deal low. You can see that the Fib 38.2 is smack on the lows there. Let's come in with the weekly anchored VWAPs on the NASDAQ side also, and you can see that we're just at the top end of the stack, but it's not like we have this big excursion into the majority of the stack, right? This would be a completely different picture if this bar ended up closing. I'm just going to draw in white. If we closed in here in the midpoint of the stack, yeah, alarm bells are going off in my head. We just don't have that yet, right? We're still in that range compression here, and it's still a little bit too early for me to want to make that bearish call. Let's take a peek over at the weekly volume profile and take a look at this. Where is our high volume node? It's still underneath us. So once again, overhead supply arguments, they get much worse if you drop that high volume node. If you can't drop the high volume node, then everybody's just kind of like sitting in consolidation, just twiddling their thumbs, waiting for something to happen. And again, could it happen this week on a labor data catalyst? Maybe. We know that earnings season are right around the corner. Well, financials aren't really going to give us a strong start in the Qs, right? There's no financials in the NASDAQ 100. So we're really left just waiting for this equilibrium to resolve. And in the intro, I mentioned that it's a stock picker's market, not a passive market. This is exactly what I mean. If you've been just passively, in the indexes, there's nothing wrong from a higher time frame perspective. But in terms of trading, the Mag 7 names are sort of, I don't want to say dead and gone, but they're just not all that interesting. And you need to sort of be rotating into the themes and trading the themes that have been playing well. So that's kind of my 2 cents on the higher time frame NASDAQ. Let's go back down to the dailies. Let's take a peek at our expected move, the whole 9 yards. You could see the expected move is here. Upper bound is at 624.30. Lower bound is at 601.94. It's an equal low relative to the overshoot low. I'm not really too fond of that. And it's an equal high relative to last week's high. Technically, actually, the Friday post-Christmas high. Nonetheless, expected move equal, maybe a little bit more bearish, right? What I would have really liked to see is the potential for a higher low relative to this low, and we're just not getting that based on options market pricing. Now, it's not an end-all be-all. It's just a suggestion, right? One thing that I do find pretty interesting is that the market did start to bounce on Friday afternoon right off of the trend line, and it did close right back over the bearish engulfer high at 613. Now, the best outcome on Friday would have been an acceptance move over this area here at 618.50. That would have offered a potential higher low in the trend count, lows, clean higher lows, and then ideally consolidation here to build out an equal high, which would start to what? Put the pressure on the weekly for an equal high breakout. It didn't really happen is the point that I'm getting to here, which leaves me a bit more neutral on this NASDAQ chart. In this range right here, in between 618.50 and 613, I think we have to be a little bit more so of the mindset that it's still in equilibrium. I'd love to call it just very, very confidently a beautiful higher low, and it's got to be higher, right? I'd love to make that call, but I just can't with the notion that we also still have lower highs and the potential for some sort of breakdown through this, and all of a sudden we're talking about an equal low. Right? So it's very neutral on the NASDAQ. I think we're coming to the crux, we're coming to the apex of this compression pattern, and we have catalysts this week that potentially get us up and out or down and out of the wedge that we've been talking about. Notice here a little bit more weakness than the S&P, failing the daily 50 SMA on both the New Year's Eve session, which was Wednesday, and then Friday also smashing it after gapping up and over it. Not really a gap, not a true gap in terms of what I would consider, but we didn't quite open out of that range, right? Maybe just at the highs of Wednesday we opened on Friday. But what did we have the opportunity for, right? Why is it not all rainbows and butterflies? Why is it not really as bullish as it could have been? I mean, bulls should have just yielded a gentle pullback here, higher low from here to here, and then we're off to the races, potentially setting up that weekly equilibrium high, and then changing the weekly trend to up via a higher high, right? That's just not, it's not taking place as of Friday. So once again, have to take a bit of a reserved stance. The NASDAQ in particular, it does not have as many sectors, quite literally, to rotate through like the S&P 500 does. There's no financial exposure here in the QQQ. So without the help of financials, look at Friday's session, right? It's very hard to have a stronger close here. Another thing that I'll point out is on the rally into the end of day, there wasn't quite any acceptance inside of Wednesday's range. If we could have gotten a close inside of Wednesday's range, more of a lower wick here off of this 613 spot, maybe it would have been a bit more compelling for, okay, we've got daily hammer. Let's see if we can get acceptance here early next week and then break to the upside. But I think base case for now, at least, short term here on the hourly chart, any consolidation in here is technically neutral. This gets bearish. We are open-minded to the shoulders and then at least the head of the inverted head and shoulders. That's absolutely in play. And then if we get here consolidate, let's say the labor catalyst is bullish, then fine. We're just looking for range rotation back up to this high. But is it a momentum breakout? Probably not. Look at how stubborn this market has been through really all of December. It fails to break out on the highs. It fails to break down on the lows. It fails to make an equal high. It fails to make an equal low. So, this is after a breakdown intraday, I'm saying on Friday, a very neutral market. And again, if you're out there, and I guess my main point in walking through all of this is if you've been slinging size and getting frustrated and you can't get traction and breakouts aren't working and breakdowns aren't working, just recognize that it's not really the market for that. Look, just the great exercise, right? New year, not new market, but new year. Look at the consolidation. Look at what the market's been giving us. then look at what it had ever since the April tariff lows. These are like two totally different worlds in the market. And, if you haven't adapted to that idea yet, then no wonder that this is like a painful period to trade. So there's a lot more sitting around, waiting, being patient, being hyper selective with your setups, scanning a little bit more, looking into the niche themes, right? That's kind of what this market is suggesting. Anyways, let's finish up the NASDAQ side with our NASDAQ internals. You'll see that we technically had volume inflows. Mag 7 is to be thanked for all of the bearish pressure that we saw. Same situation as the S&P NYSE side of the market. Let's go on over to the market profile. Let's give this a little reset. There we go. We don't quite have a poor high. I'd say it's got a decent excess in A period, decent excess in I period. Value area is certainly lower than what we had on the Wednesday session there. Point of control is absolutely lower. One thing I would just pay attention to is it's not quite single prints because you can clearly see the C period overlap, but this is fairly emotional selling, right? This stuff in here where B and C are overlapped, A and B are overlapped. It's not single prints again, but it is single-ish. It's thin structure. Look at the volume commitments at price. Very, very light relative to where the value built out on the lows of the session. So therefore, bringing this full circle, let's land the plane here, Matt. I would say if we can get a break up and over 25,460s on NQ, aka a recapture basically of the Wednesday low, that's probably where you put the squeeze on, and any shorts from late day on Friday might start to rethink their decisions. Ooh, do I want to be short here? The market's in a consolidation. It's a bit more neutral. Maybe I don't want to be short quite yet, right? That's where you get a little bit of that potential for a squeeze in the upward direction. Again, not a home run. Oh my God, market's going to break out to new all-time highs. But on the NASDAQ, if you could just get a little bit more acceptance inside of that Wednesday low, if you could accept more firmly over 613, wouldn't be unreasonable to rotate where? Well, back to the daily 20, back to 618.50, which, as we know, is kind of our no man's land. Better market moves should happen if we can get acceptance here to here, or if we can get acceptance here to here, right? That's kind of the thesis of the NASDAQ this week. Let's see if we can get out of this no man's land zone, no man's Zand. Towns Van Zandt comes to mind. But 618.50, 613. All right, enough's enough of that. Let's take a peek over at the IWM. Let's go up to a monthly time scale. Let's get the job done here. Let's bring ourselves volume. Let's get rid of those corporate actions, and let's go ahead and just take a look at the moving averages. Perfect. We also want a clean drawing set. Absolutely. And let's take a peek here. So IWM, and I'm just realizing before we get too deep into the IWM, I got to go back to the Qs, show you the expected move. Apologies for not bringing this up. I would have preferred to do that as a congruent analysis of the NASDAQ, but we find ourselves here. 504 yearly expected move low on the Qs, and then can't read. 724.50 is the expected move high of the year for the NASDAQ based on options closing on December's end of year sort of cutoff, right? That's what the options market's suggesting. Doesn't mean we have to go and tag either side, but one standard deviation based on options pricing, there it is. Okay. The January expected move 641 on the top side and 587.50 on the bottom side for the monthly bar. Now let's get back over to IWM. Let's take a peek at our monthly chart here. Much more of a suggestive candle of a failure, right? Inverted hammer in terms of candle structure. Instead of a doji, there's no lower wick on this thing whatsoever. It's just a straight up upper wick, which fails the all-time high in all of its glory. So really weak close, not too fond of that. January seems to be off to a neutral start so far. Monthly time frame here, I believe, still has the odds of a higher low. You could do something maybe in the midpoint of this, right around in here, closer to about 225s, 226s is technically the weekly thesis in here that we could pay attention to in just a moment. So if we were to get some consolidation on the monthly, this looks fine, and then a Brigade bolt into blue sky territories sets up a multi-year consolidation breakout. But as of right now, looking like a little bit of a failure. There has been some small cap resurgence to kick off I shouldn't say kick off, but end 2025, and then as we start here 26, maybe that theme persists, we shall see. So once again, this area right around 226, 228, there, monthly 20 SMA, that would be the higher low to keep this intact and moving in the upward direction. Let's check our fibs here. April lows up to the highs. Fib 38.2, spot on with that suggestion. That's pretty much the same fib if we come in from this low up to the high as well. Maybe a little bit more of a zone down there, but fairly close. In terms of let's go to the weekly chart. Go over to weeklies. Weekly bar is a little bit more constructive than the monthly bar for sure. We've got ourselves a red hammer candle here, large lower wick indicating that buyers did step up on that Friday session to kick things higher. It's the only green index product on the watch list over here, holding the weekly 20 SMA with plenty of room for a weekly high or low. Am I concerned about the weekly chart? No, this actually looks fairly compelling. Nice rally through the Thanksgiving situation, as we know. Decent little pullback for a bull flag. If this can break the weekly high, I think we're talking about back to all-time highs on small caps into the coming weeks worth of trade, especially if that labor data starts to give us the slight suggestion that the Fed will continue to be accommodative through 2026 and more cuts are on the way. That's certainly helpful for our small cap side of the market. Let's come in from this low up to this high. So far holding the fib 38.2. That makes decent sense if we come in here with our fib anchored, not fib, just the anchored VWAPs. There we go. What do we see? Holding the top end of the stack. We've got a nice little hammer low off of the previous high and the swing low from in here. And again, if we break the weekly high, it's a break of the all-time high anchored VWAP. I would think we go back to the all-time high. All right, so that's looking all set from that perspective. Let's come in with the weekly volume profile just to take a peek. And as we know, let's just do this. Boom. Break of that level gets you back to the all-time high. And this is really the major node, if I'm being honest. A little bit further down, this previous high acted as loose support in here. As long as we're above that on the monthly time scale, as we just saw, really no problemo. On the monthly chart, we were also talking about this, which is closer to that 226, 228 high volume node breakout point from the weekly. We already got a weekly high or low above it, but the weekly trend did not flip to down. If the weekly trend gets to down by getting here again, so this would now be double top, break this neckline, technically come into it with maybe an overshoot, that would be your monthly high or low thesis. We're not there yet. It's not a top of mind priority. As of right now, small caps have a beautiful hammer candle on the end of last week. Let's go to a daily. Let's take a peek. And what do we see over here? Start to get a little bit more neutral when it comes to daily trend. Let's firstly evaluate expected move. Upper bound at 253.57. Lower bound is at 243.99. So is that bullish or bearish? I'd say a little bit more bearish, right? Because you could certainly see a lower high happening from here and here, as well as a lower low happening underneath this, as well as that we just drew in. So expected move bearish. One thing that I would be keeping a very close eye on, though, is this swing low, right? It's not really even a swing low. I should just call it like a gentle pullback low. If we take that out, we lose the daily 50 SMA. If we hold on to it, then I think everything's fine on the higher time scales, including the weekly. The weekly chart is also a break of the month, daily 20 SMA. We know that the weekly bar, if I was just to superimpose that here real quick, the weekly bar looks like this. This is your weekly lower wick, and this is your weekly upper wick, right? If you break the weekly bar high, you're also inherently taking out the daily 20 SMA, and once again, I would be thinking about the all-time high as a potential target. That's if we can get this thing moving in the upward direction. How does that happen from a granular perspective? Well, Friday's hammer high needs to break first to get to the 20, develop a higher low on any pullbacks over that high at 248.25, and then constructive walking the chart up like that. The time to sort of throw your hands up in the air and panic, oh my God, it's the end of the world, is, like we said, if we drop this on the expected move and then accelerate, there's really just thin structure through here, which is pretty detrimental all the way down to 239s, right? Let's go on over here. Let's take a peek. Of course, pattern traders rejoice. There's maybe the Man Ray pattern. Let's draw in a couple of eyeballs over here. Not Man Ray, the supervillain, although this kind of looks like him. I'm talking Man Ray, the French photographer. Right? Come on now. We've got to be cultured up here in the office. So anyways, there's your pattern. And if we crack the neckline, look left. The point being is that there's really thin structure through here. I would be open-minded to this being a major headwind for the S&P 500 should these small caps break down underneath 245.25. Again, no glaring indication that that is the top priority headed into this week. If we get there, if we build out bear flag consolidation on the hourly as such, fine, we'll change our tone when and if we get the Brigade bolt. But for now, the daily hammer, the weekly hammer, if we could do this early on in the week, it keeps things neutral. And then this is where I'd be expecting to move back to all-time highs, which would be bullish pressure for S&P 500. Small caps inherently moving higher. There you go. That's your sort of route as a tailwind for the S&P. Okay. Now that we've covered that, let's take a look at some fibs for our small caps because it's a little different. The candle structure is much different. The chart structure is much different. Fib 38.2 is trying to hold on. 61.8 is the line in the sand, and we can see how we can get there, right? There's an easy path to get there. This would then have to be the higher low from a daily perspective if the trend's going to try to remain up or at least neutral, right? In terms of this, coming from the high down to this low, there we go. I just want to point out, right, that recapturing the 61.8 should generally increase the odds of a 100% retracement towards the all-time high in this case, right? There's your 100% retracement. So just reinforcing that getting out of this zone probably holds the secrets for small caps, here or here. And as we know, catalysts via labor report this week, jolts ADP non-farm, first taste on Wednesday. Friday, full Monty labor report. Thursday, also with the week-over-week jobless claims. Okay, that is IWM. Let's take a quick look at the intraday anchored view app set over here, because why not? Underneath a majority of the stack versus the Qs and the S&P, which were right in the middle of the stack there and very neutral. So a little bit more bearish on the hourly, certainly a bit more of an aggressive downtrend here. We saw the monthly bar looking pretty aggressive with that upper wick. It's push-pull. I honestly have to just call it for what it is. It is push-pull. If this was a more bearish market, probably wouldn't have seen the rebound on Friday in small caps, noting that the remainder of the market was also selling off quite aggressively based on the Mag 7 name. So, of course, no Mag 7 influence over IWM, but you get the point. Broad-based weakness. Oh my God, panic, sell everything. It's the first of the year. You'd also see small caps get hit. Let's take a peek over at the Russell side of the market internals. What's going on from this point of view? You could see that we are not even close to that trend higher zone on Friday, much more neutral out of the advanced decline line, and a very lackluster build on the cumulative tick. Nothing to really write home about from that point of view. It aligns with what we've been saying recently, which is that in this box, right, your clarity comes from this, your clarity comes from this. The fact that we're holding the lows on neutral market internals, maybe a range low bounce, but I wouldn't mortgage the house on that, right? I would think that clearing the weekly high, getting here, is where it becomes much more compelling for upside with the help of labor and Fed support. Let's take a peek over at the Russell market profile, and let's just take a peek, get a couple more. There we go. You can see the value area is higher than what we had on that Wednesday New Year's Eve session, and it's also, point of control-wise, higher than what we had on the Tuesday session. So nice, impressive move here. Poor low, unfortunately, on the low of day. Let's zoom in a little bit further on that. Yeah, maybe just lack of material excess, 1 TPO of excess in there. Yeah, 1 TPO of excess. So not really enough to call it a decent auction low, and also lack of material excess at the high. So really a wait and see market on small caps. I think that a lot of people will be holding their breath for that labor situation. So let's, without further ado, continue through the analysis and see what we're working with over here sector-wise. Then, of course, fundamental evidence, the whole 9 yards. What do we have in terms of sectors? Who was leading, who was losing, and where was the weight? You can see semiconductors, in a weird way, lead the week up 2.94%. The reason I say weird is because we know that the Mag 7 names took kind of a beating. But, I mean, NVIDIA, not really all that bad, only down about 52 basis points. Take a look at their TSM and MU and AMD. All of those names substantially higher on the Friday session. So semis still look to be okay, right? It's really the enterprise software names that really took a beating. I don't know that you'd call Amazon or Google that, but maybe Microsoft and some of the others that we'll get into today. But SMH doing well. That's risk on. It's followed by energy up 2.56%. I don't want to hear it in the comments about, what's going on internationally and all the oil experts coming out of the woodwork. If you've got oil credentials, if you've been trading crude for your lifetime and you know exactly how this is going to respond, I'd like to hear from you, but I don't want to hear from people who were silver experts last week and then they were tariff experts in April. I consider myself a chart expert. I'm not going to pretend to know the ins and outs of the global oil market and the infrastructure and how things are going to change based on what's happened this weekend. So energy has the potential to move in a big way here this upcoming week. I will be trading the chart, not the narrative, just putting that out there. If we look at utilities, up about 86 basis points, what I want to just point out here is that energy, lightweight, utilities, lightweight, and also defensive, it's a mixed bag of posture up at the top end, which once again points more towards rotation as opposed to anything else. The bottom end of the barrel is discretionary, down 2.64%, followed by financials. They had a good day on Friday, but financials down about 1.19%. And then you can see here real estate, pretty much the third sector, right? Let's ignore the TLT for a moment, down 76 basis points. It's not like the market just totally puked out and died everywhere. It's just the Mag 7 names really took a big beating, and because they're so heavily weighted in terms of market cap for the S&P, that's why you saw the market lower there. But looking around, it's not really that bad. Take a look at this SMH. Once again, we'll look through, let's just do it, SMH first, then the components, but this looks really good, does it not? I mean, gap and go on Friday, consolidation here, Brigade bolt into blue sky territories. Yeah, semiconductors are, moving, not necessarily your NVIDIAs of the world. NVIDIA just can't seem to make up its mind as to whether or not it wants to get in gear over the 50 or not. That's hence the title and intro of today's video, right? Big sort of failures, failed breakouts to start the year, but look no further than something like an MU. Right? Look at this monster. It probably deserves in 26 to find a permanent home on the core list of companies. I'd prefer the options got a little bit more liquid, more eyeballs, more people trading them, but MU, huge break to the upside. TSM, Huge break to the upside over a multi-month consolidation phase. I mean, these things have to be top watches, and these aren't even trade ideas from the 7 additional ones I have for you later on, right? TSM, go look at like an ASML. We talked about this not too long ago. I was a little disappointed on this big overshoot here, but I mean, gapping right back up in the upward direction, brand new record highs. Weekly trend remains in the upward direction, and AMAT of the world, not really all that bad, right? Getting a gap and hold on that Friday session. So, I mean, even dare I go look at something like an SMCI, I would not opt to ever trade this or touch this with a 90-foot pole, but you'd figure on a day where the market's down, one of the worst semiconductors out there might not be performing as well, but it technically had an okay day, up 3.34% on Friday. Right? So when it comes to that stuff, it's not the end of the world looking at this sector posture here. If you look at energy, once again, I'm just going to trade the chart in front of me next week. If we're just sitting here at resistance, I don't know that I'm a big long in energy names. The best energy name out there, and everybody's starting to talk about it. We've been talking about it for a couple of months now in the, we sprinkled it into a couple of these videos as well as in the office, of course. But, you get this massive monthly bull flag on XOM starting to potentially break out on a catalyst involving one of the largest oil reserves in the world. I mean, it's worth keeping an eyeball on for early next week, right? So XOM, it definitely comes to mind in here. But if we just go back to the XLE, there's nothing really compelling about this other than saying, okay, we're trying to grind in the upward direction. If you want to take a stab at it and tell me where crude is going to open on Sunday night at 6 p.m., you can feel free to do so over on X, right? We put out a little post on X. Feel free to reply. And maybe, just maybe, if anyone gets it within a plus or minus, let's say, 2-cent increment, if you are within plus or minus 2 cents on the open Sunday night, you're going to get yourself a nice little prize. I'll put that out there in the world. You have to comment on the X post. You cannot comment on this video. It's not going to count here. You need to comment on the X post. If you don't have X, I'm sorry. Go make an account, but that's just the nature of how this one is going to go. All right, 2 cents, plus or minus 2 cents, and you can't call it at 6 p.m. on Sunday. Time zones, none of that stuff. Has to be in before 6 p.m. on Sunday, and you might win yourself a prize. 2 pennies. There you go. Show me the number. XLE. Let's go XLU. Let's see what's going on over here. I think that it's definitely possible utilities go inverted head and shoulders, catch a little bit of lift in here. That's an idea to keep market rotation alive. I'm not overly compelled about the chart one way or another. If we look at the XLB, flat top highs, potentially ready for a breakout on more consolidation. If we can make this a little flag and then break out of it, great. You would look for names in that theme. And once again, being a picker's market, not a passive market, probably worth diving into the XLB. If you're not familiar with the tools in Thinkorswim, just go to Analyze and then Fundamentals, type in XLB, and of course you'll get your big heavy hitters. Lind, Newmont, CRH, Sherwin-Williams, all these guys, right? So you could find your components that way if you're trying to do some top-down analysis of, okay, what sectors are hot? I know I need to be a picker. I know I need to be thematically relevant. That's how I would do things of that nature, and then you just build your lists, right? Take a look at this. We go over to personal. I've got my lists, right? You can see my lists in here, and we'll get into some of those lists when we get to our trade ideas later on. Let's go industrials. Industrials over the all-time highs, bullish, of course. This looks pretty good. I believe CAT had quite a day on Friday. Yeah, there's CAT up and over the daily 20 and this sort of double bottom-esque neckline higher low off the 50. That looks pretty good for your XLI. Let's go XLY. On the other hand, Tesla absolutely brutalized. Amazon absolutely brutalized. Mag 7 names, right? And XLY is going to reflect that. So a failed breakout at the all-time high. This looks pretty rough. The next thing that needs to happen is a higher low. If we can't sustain a higher low, not really on par for, or on pace, I should say, for a nice start to 26 on discretionary, and perhaps we just have to backburner Tesla, backburner Amazon until these robotics themes maybe play out in a more substantiated way, and there's like tangible results, right? On the delivery numbers from Friday morning on Tesla really didn't go over all that well, right? So that's the XLY. Let's take a look at financials. Although it was down on the week, take a look at this chart, and you tell me, bull or bear? I don't know about you, but this is a perfect bullish situation, right? A look above the first flag high, pulling back into the major range high with a hammer off the 20 SMA. So anybody who was like early long on the first leg gets shaken out. This starts to build a new, consolidation like this. I get it, head and shoulders, right? It's a threat. But as long as we're over this consolidation, and as long as the banks look the way they do, look at your JPM. I mean, this thing's beautiful. We would talk about it in the core list of companies anyways, but look at this flag over the range. Looks fantastic. Looks like it needs to play catch up with the likes of Morgan Stanley, which is one of the trade ideas. That one should be coming later. And then Wells Fargo looks like it needs to catch up to that. Citibank, right? We've been talking about these banks nonstop. XLF, the rotation theme, it's there. It's absolutely there. The big headwind for financials right now happens to be Visa and MasterCard. See the big overshoots, the failures to hold over the flag range high? That's Visa, and here's MasterCard. If this can catch itself at the moving average stack and catch a bit of a bid back up to like 580s, that would be supremely helpful for the XLF and thus the S&P 500. So let's keep an eye on that stuff. Here's the TLT. I'd be interested in selling bond puts if we can get a big uptick in implied volatility. We just haven't seen it yet, so there's nothing to do yet on the TLT in my view. The XLRE breaking down from a 7-month range, maybe lower highs. The moving averages are starting to spread out a little bit more firmly. Does this drift to the downside? I'm not sure. I would like to see, the relationship to rates and whether or not there's a big response from the Fed on labor per se. And if rates are going to come down aggressively, then real estate should technically perk back up, I would think a little bit. If there's no budging from the Fed on rates, then I would tend to think, lower real estate maybe opens the door for... It's kind of interesting. Like there's some, it's very, very regional. Please, like your market may vary, but commercial and residential is so hard to find in the two markets that I specifically watch, and the prices just aren't dropping. There's just not enough inventory. So we're still in that situation, and maybe this leads to lower prices. I don't see it yet. I just don't see it yet. Needs to be a big glut of inventory that hits the market and maybe changes things, but not there. And you can go look at the stats of the majority of people have rates, sub 3%, sub 4%. It's like 80% of mortgages out there. Anyways, XLK is going to look almost identical to the QQQ, so let's not belabor the point. I think that there's not much to do here. If you Brigade bolt out of the range, great. Over 146 keeps the bullish pressure on. Underneath 143.75 puts the bearish pressure on. Let's move on over to the XLP. Looks still like it's trying to build out that right shoulder, but it's not all that compelling in here. The gap and hold is not great. If this slips and falls, I think the retail theme might suffer a little bit more. So it looked like there's maybe a little bit of a second wind coming in something like a Kohl's. This quick little, it's not really even there. I was going to say a little undercut and rally, a little look below and fail. Not really. I think it's maybe a bit more obvious. There it is on Macy's. There you go. So this little leg from in here, this low, you overshot it on the hammer and you rallied there. If we go to AEO, you can see some of this stuff, right? You look below, fail, hold the daily 20, ANF is going to look decent, right? And then, of course, Urban didn't quite hang out with the rest of its friends. So with that, the retail theme slowing down a little bit. Again, if the XLP breaks underneath 77.50, consumer staples might not do so hot. I get it. You're talking more about your Unilevers and your Colgate Palmolives in this particular chart instead of the XRT, which would be retail quite literally. But that's the general idea. Spending on apparel, things that people need, it's just not, nothing to write home about on this chart. So 77.50 is a level to watch. XLC, let's take a peek over here. Not the worst chart out of the lineup. I would say that the XLY is probably the worst one out there. But this in here, it's a failed breakout. I'll give it that. The only thing going for it is that it didn't technically sweep the all-time high, so we could still yield some sort of consolidation and then another attempt at it as we move forward into 2026. As long as we're over this 115.50, I think we're all right. But if Meta starts to weaken in a more substantial way, and Google, more importantly, if that loses Google 310, I think we're in trouble here on XLC. That's TBD. When we get through the core list of companies, I'll show you what I'm talking about. XLV, healthcare sector, still looks okay for a, I think this is potentially, we classify as a low cheat maybe. Up and over these highs, fine. Your pharmaceuticals are still the primary movers in this space. Forget about your UNH. I don't really think that this looks good in here. It's kind of compressing. It's underneath a descending 200 SMA. If it builds out like a multi-month base and, then breaks, maybe, but look no further than like a BMY, trying to hold the daily 20 SMA on a pullback here. Johnson & Johnson sort of giving it up here into a bit of a head and shoulders now, but look at the low is basically what I'm trying to mirror to that XLV. You could look at something, Pfizer's always been a laggard in there, but let's maybe go to Amgen is the one I'm thinking about. Amgen in here, holding the moving average stack. Can we set a higher low? Like these kind of things would play in nice with the XLV. And if you want my favorite one, did I write it down as a trade idea? I did not, so I'll give it to you here as well. CVS. Take a look at CVS up and over this high right there. Not that maybe this is directly linked to healthcare. You could say that they have a pharmacy inside, but they sell consumer staples names as well. So anyways, CVS over 81, that makes me think of that out of this little range here. It's a possible idea. It does okay range. It's on the lower bound of the average 20-day, but that is the XLV. A little bit of stream of conscious through the sectors as we were looking through different components in there, but let's get a little bit more on track with our typical analysis. Let's take a look at some ratios. If you're not familiar with the ratios, this is how we gauge risk on, risk off. Check out the video tutorial top right-hand corner. I would say this is pointing neutral. XLK did not break in a big way up and over the 50 SMA through the holiday weeks, and therefore it's hard for me to say anything constructive and bullish. XLF mostly sideways, XLC mostly sideways, and a rollover in the XLY, unfortunately on Friday, underneath the daily 50 SMA. That just can't remain in a bullish posture for risk on. So really neutral here, just noting that the XLP is not outperforming, nor is the XLU, but that could happen in the blink of an eye. Let's take a look at it through this upcoming week. If we go to the risk on-off A-B sets, again, look at these charts. What direction are these pointing? Mostly sideways, 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 down, and down. So it's hard for me to say risk on here, but it's not quite full-blown risk off. If these were pointing down, I'd be much more concerned, but a little bit more neutral for now. Let's take a look at the B set. We can see over here the gold and S&P ratio. Small uptick there as gold pulls back. And then if we take a look at Bitcoin, starting to get a little bit of a bid here on that Friday session. I'd be curious to see if this can break the flag high and squeeze out some shorts. The Sailor Shift tool is just hardly at the zero mark. Let's see if this week can flip it to up. That would be bullish for risk appetite. And then, of course, SPY TLT ratio. Nice higher low, still persisting on the highest high, grinding in the upward direction. Risk appetite here seems to be okay. So what's the bottom line through these supporting evidence charts? It's really not all that bearish, right? It's not a big wave of risk off washing over the market and saying, oh my God, sell everything. It's like we had concentrated risk in the S&P Mag 7 names, NASDAQ Mag 7 names. That was kind of it. Other than that, it's pretty neutral out there. Taking a closer look at the dollar, expecting more volatility here as we get into the labor data this week. Same thing with rates. I mean, you could clearly make the argument that this looks like an inverted head and shoulders, roughly. Something that looks like this, possibly, another higher shoulder in here and just asking for a break up and over 4.2. What that does for the market probably compresses some valuations as well as hurts those small caps quite a bit. We'll see once again what labor has to say about that. That's really what I'm holding out on for a larger stance. And this is the first, what should we say, non-tampered with data or clean data collection that we've gotten since the shutdown, which is pretty meaningful when it comes to labor, right? So there's that. Let's take a look at the inverted ZT. Any expectations of a rate change? I mean, it's unchanged from what we've been dealing with the past couple of times. If we move on over to here, you can see we're still around that mid-80s. I just realized I did not change my crayon back to black. It's still yellow. So let's maybe go on over to red. That'll stand off well enough. There is your 83.4% odds of a pause in the next meeting, which is the 28th. We'll see where we land after the labor situation. Again, really putting a lot of emphasis on the first round of clean data into the new year. I know it's December data, but new data into the new year. How does the market respond? How does it, track for the Fed? And what are the expectations here? So speaking of the data, here it is, right? This is what we're looking for this week. As we could see here, ISM manufacturing PMI on Monday at 10 a.m. That'll be important. If you take a look at the ADP non-farm, that's 8:15 on Wednesday morning. So pretty quiet on Tuesday for what that's worth. Oops, here we go. And then ISM services PMI, a larger deal than what we have for manufacturing, services being more sticky. Then of course, JOLTS is the big deal as well. So 8:15 and 10 o'clock on Wednesday, January 7th. I mean, I've been talking my head off about it here in the pre-market preps. I've been talking about it in the weekend update videos that we've done around the holidays, right? It's like, just forget about data during the holidays. Wait until the 7th, right? Here's the 7th. It's finally upon us. As we scroll lower, you can see the typical jobless claims on Thursday. And then here it is, the full Monty labor report coming out on Friday, January 9th. As well as preliminary consumer sentiment and inflation at the 10 o'clock time frame. So pretty busy this week, big data dump. And what we basically want to avoid, if I just had to give a quick summary of what I'm looking for, you want to see labor firm up a little bit. You don't want to see a wage price spiral. You want to see the participation rate remain elevated, and you don't really want to see JOLTS contract too much, because if there are fewer job openings, people are going to demand, other way around. I got it backwards last time too. If there are more job openings, then people have to incentivize companies, have to incentivize with higher wages, of course, and that's how you start to get into wage price spiral. And if services inflation starts to go up a little bit, then now all of a sudden you paint a picture of inflation not really subsiding to the Fed's 2% target for 26, which will probably be less optimistic for small caps, and maybe we get a year of consolidation, something maybe similar. Not forecasting this. Again, I'm just like giving a comparison. if there's no growth, if the labor situation's rough, if the Fed has to keep rates higher for longer, or maybe even hike rates again, maybe we're talking about a 2022 grind. Not talking about the magnitude of the pullback, but more of a grinding market back and forth, right? Just something to think about. Again, not a forecast that we're getting a 2022 market based on the economic data, but just giving you a thread of my thought here. Let's move along. Let's take a look at the earnings calendar. It's pretty quiet this week. I'd say the big deal is really next week when we get JP Morgan to kick off financials on Tuesday. So honorable mentions perhaps going out to maybe Applied Blockchain here, APLD. What else? That's really it. If I'm going to be honest, that's pretty much it. Tilray might be interesting because of the legalization status that's been bouncing around in the headlines. Other than that, not really interested in anything over here. So we'll leave the economic calendar and the earnings calendar on that note. And hopefully as we ease into earnings season, we'll have some more interesting data to report on. Anyways, bond relationships, what's going on in these? You can see that we're dealing with a market that's mostly back on par. So this, of course, is an uptrend versus this neutrality, but this is neutral, this is neutral, this is neutral. Not really too divergent. The market's spoken its mind about the inflation bit once, and for now is just kind of remaining tame. Let's take a peek over at the credit spreads. No change at all last week in the lower, which is typically the one that we give the most credence to, and we'd like to see this start to snap up and move underneath the 50 SMA. This would just indicate that volatility is pretty stable, which, as we'll get to in the VIX, that's exactly the case. If we look at the HYG, there is a subtle bullish divergence here in the very short term. I totally get the idea that this absolutely is a lower high versus the equal highs that you just kind of have here. I get it. But in the short term, right, if you're a bull, you kind of want to look at this SPX breakdown in here. Let's see if I can align these zooms. There we go. You want to look at this, and you want to look at this and say, okay, lower low in the SPX, but kind of equal/higher low in the HYG. Scratch your head and say, okay, it's really not all that bearish, right? If high yield junk is and bond participants were really going to say, oh, geez, headed into 26, we want to just unload everything. It's a risk-off year. HYG is going to be straight down, kind of mirroring the SPX, and you probably would have had a worse day in the SPX. So for now, small bullish divergence. What does it mean? Let's just go back to the major thesis of the S&P 500. We're kind of stuck right now, waiting for some data, waiting for a catalyst, waiting for a break. I think there's still an opportunity for a higher low. I do not think it's worth getting aggressively bearish based on all the high time frame analysis, the supporting evidence that we've walked through in the sectors, even like market internals. And let's just take it one step further. Let's take a peek over at breadth. Right, let's go look at breadth. I mean, breadth, as you can see, had an uptick on the Friday session. If you look at the RSP, the equal weight S&P 500, it closed green. So that rotation thesis is keeping me more bullish for the S&P. If you're going to short anything, I would certainly look more so to the NASDAQ side of things, less so to the S&P based on all of this evidence that we've been sort of compiling. We're piling it up. So total breadth looks fine. Let's go equal weight NASDAQ just to get a sense of how this is performing versus the Qs. I'd say it's more similar. You're getting less of that outlier divergence like what we saw in the RSP. And then let's take a peek over at volatility here. So VIX absolutely floored underneath 15, which again, think about the S&P being down on Friday, and yet the VIX is also getting crushed. It doesn't really speak to like a big Armageddon sell. VVIX also not really aggressively over the 103. Armageddon sell not really there yet. You're just getting like a neutralization of volatility. And then the contangos are huge, right? The posture of VIX, current VIX versus next month, as well as the months after that, they all speak to being in proper alignment and money managers being comfortable allocating dollars right here, right now, today. So no real issues through the supporting evidence. If we look at skew, it got crushed into the end of last week. Take a look at this big move down. It's basically range high to range low from what we've been dealing with off the April tariff lows. It just means that nobody's really betting on, Armageddon. Nobody's really out there buying a bunch of insurance, causing out of the money puts to get aggressively out of hand there. So, I don't see anything through all of the charts we've looked at so far today that make me think, oh my goodness, buckle up. 26 is going to be an end-all be-all year. It's terrible, right? It really looks like we're in a picker's market, as I've said now a couple of times. The market's in more of a higher time frame equilibrium, let's say the weekly, right? The daily trend is trying to remain up with lows, higher lows, and the potential for a higher low. We need an hourly trend reversal. We need to get confidence here. And if that's the case in a still rotating market, I might be skeptical and hesitant about buying the breakout in the broad market. I wouldn't, be an ES buyer up and over these highs here, but it would make me a bit more confident trying to buy a breakout in a thematically relevant, spot. So to get to themes, we have to get through the core list of companies. Let's take a look. What's going on over here with NVIDIA? As we mentioned earlier, a bit of a failed move on Friday, not able to take out this prior high from the Friday the week before, and instead starting to suggest maybe a bit of a double top. Now, is it bearish? Probably not, because as we can see here, this double bottom is still in play, and you're just caught between a rock and a hard place. If we could catch support more firmly off of 184s, maybe that's a long here for risk reward, but just trying to buy this in the middle of this slop, I just don't see it. I don't see it on NVIDIA. So I don't want to be more bearish than I have to be. I don't think there's much of an action item to take in this range other than if you sort of get the sweep at 184.75, maybe it's back to the range high. If you fail this, it's just no touch. It's okay, dead and gone, lower high, focus on other semiconductors, as we already saw, TSMs, MUs, ASMLs, all the, they're more of the fab spot. You get the idea. Let's take a peek over at Apple and see what we can see over on the one stock. Used to rule them all. I'm sure you could maybe hear the siren flying by in the background. Sorry, it caught my eye for just a moment. Anyways, Apple, big failed breakout. Okay, this is where we start to look at these really tight ranges that failed to go higher meaningfully on Friday and actually closed on the low of session. So as we're thinking about Mag 7 and waiting to the S&P 500, this is brutal. This is an absolutely atrocious chart. You would have liked to see a strong close over on a recapture of the daily 20, the daily 50, and instead you closed on the lows after failing that move at the highs. So what do I make of that? I mean, it would not be unreasonable that Apple maybe turns into head and shoulders here, and suddenly we start talking about this, right? Now, it's not in play right here immediately on Monday, but, we start to consolidate here. We build out a descending triangle on the hourly chart, a Brigade bolt there. Yeah, it's a conversation we can have underneath 265. So patiently waiting, I think the main thing to take away here is these failures really impact the broad market, right? And also, index in the back of your head, what these charts look like compared to some of the charts I'll show you as trade ideas in thematically relevant spots. Okay, let's go Microsoft, another one, just completely getting obliterated outside of this really tight multi-day range here. Gave an attempt to break out higher on Tuesday, failed Wednesday, and then on Friday, just game over, right? Failed the daily 200 SMA, right back down to the range low. It's an ugly chart. You got to call it for what it is on the higher time frames. This is now a weekly double top. It's been a weekly double top, but we've been talking about this weekly rock in a hard place, right? Daily double top neckline versus prior weekly high. If I go to a weekly chart, right, we could see, there it is. So is this going to be weekly bear flag to break down and offer some more pressure to the S&P early on in 26? Certainly seems reasonable based on the big failure on Friday. So I don't just want to get short into support here. However, if this range is going to break and give way and the broad market's continuing to offer weakness, might be something to watch underneath that 468. Let's keep moving. Amazon, another one. Take a look at these multiple days of really tight sideways compression. You're doing all right here because you still have some opportunity for a higher low, but big failed breakout. You moved over these highs at 233, completely failed back down underneath the 50, 20, opening print, underneath 227, weak close. Looks horrible. Looks absolutely horrible. So I'd still be maybe thinking range compression in here, but the failure of the breakout, that is the thing that we care about, right? It's the fact that buyers had initially enough spurt of momentum to try to get higher and then completely let it go into the end of the day, right? That weak close on the lows is the issue. So for Amazon's game planning this upcoming week, I would think in here is like bear flag consolidation sub 227, and then we just look for the daily 200 and reevaluate at that point. The only thing I'll say about these charts that sort of got brutalized, let's go to Google because it looks the same. The only thing I'll say about these charts that really took a beating on Friday, Mag 7 names, if there's, who knows what the catalyst outside of maybe some of the geopolitical Venezuela tensions that we're seeing already, who knows what the catalyst might be. Maybe we get a tweet, maybe we don't get a tweet. If these charts open over the opening prints or in these upper wicks that we're seeing, so that would apply to Apple, Microsoft, Amazon, Google, if we get opens over those opening prints, we put the pressure on the shorts in a big way, in a big way, right? So I would think be open-minded to a squeeze if you get a high enough gap up open, but that is absolutely not a base case. Right? So just have that in the back pocket. Anyways, Google breaking out over the 315, gapping up in the pre-market, and just no follow-through, right? Right into these highs, rejecting, moving to the lows, back to closing unchanged. This one maybe looks a little bit better because it didn't take out the range lows of the consolidation, but it's still not what you want to see on a breakout, right? Not even close. So we'll see if we get some clarity into the early stages of this upcoming week. Let's keep moving to Broadcom. Another one. This is not a semiconductor that I would follow with relative strength. I mean, just a pure rejection of the daily 20 and 50. We've been talking about over the last couple of weeks how this was a failed breakout. Earnings just really demolished this thing. So I would stay away from Broadcom on the long side. Again, MUTSM. Those are the ones with strength. It's not a recommendation to just buy them, up 10% off the moving averages or, however extended they are. Don't just blindly buy those things, but as trades, they offer better opportunity. Let's go on over to Metaverse. Metaverse looks much more consolidative in here, much more sideways. This is where that XLC retracement comes in, and that's where I'm interested in a short. If the meta chart can break underneath 637.50s, count me in, coach. There's not much holding it up here, and I would expect this as a possible idea. If it just bounces off of range low and stays sideways, nothing to do. Let it build out, cup and handle, call it for what it is. When we get into the earnings gap, that's when I'll strike. But meta in this box right here in the moving average spaghetti, no thank you. We'll leave that to someone else. Let's go on over to Tesla. Brutalized into the end of the week, failing the daily 50 into the close, failing the 20 earlier on that week, Monday session in particular. And so at this point, sure, opportunity for a higher low, but back inside this range doesn't really look momentum driven. Maybe earnings is the next catalyst that we can look forward to. Maybe we hear something nice about the robotics element of Tesla, but for now, market did not like delivery numbers underneath these highs. I would stay away from Tesla. It's been really, really lackluster to trade. Shout out to Tick in the group who caught an awesome short on Tesla on Friday, but other than that, pick your spot carefully intraday. Very, very tough stock recently to get momentum follow through in the upward direction. So certainly not bullish Tesla at this juncture. Maybe looking for a low to build out that higher low on the daily chart, but it's just, there's nothing compelling yet for me to want to get long here on Tesla. If I go on over to the hourly chart, right, I mean, you overshot the bottom end of the level, lower high underneath, closed weak. It may be on a 50 SMA recapture. Even that doesn't really compel me all that much because as we know, the best higher low on Tesla would have been here over this flag breakout from the first overshoot on the lows, right? So Tesla's not really it. Let's take a peek over at JP Morgan. I gave you the heads up on this one earlier. It looks great as a bull flag here. Bullish engulfer on Friday as well over the Wednesday high. And Friday was like the only Friday that's ever felt like a Monday. I saw that circulating all over the place online, and I would say, yeah, definitely felt that way. If this can keep going, all-time high. Financials look great. Little pre-earnings run-up. They do report on the 13th pre-market, so I think JP Morgan's got to be a top watch here. Does it hold the top end of the range? Can we get some kind of lift in the upward direction? It's the most liquid of the large banks out there. It's the heaviest weight for the S&P 500. So JPM is actually on the radar. Although the ATR is not great, if I can weasel my way into some options with enough time on expiration, if there's enough liquidity on the chain, might be worth a little bit of a shot trying to get that all-time high test. Let's keep moving here into our Palantir, one of the worst offenders on Friday, down 7.41%. Just getting absolutely destroyed. So what's this got to offer us? Not much. Weekly and monthly equilibrium here, starting to look a little bit more like a distribution, right? Because this failed breakout offers a lower high. If it was momentum driven, you'd at least expect some attempt at a higher low here. Not the case. Seems as though these higher prices were immediately sold into rather than any sense of acceptance or buyers trying to set a higher low. And that was primarily this week, right? Monday, just the gap and go to the downside and getting worse on Friday. Now, I would be interested in a potential put sale position, so short puts, meaning technically expressing a long direction on the stock, if we can get IV to really ratchet up just a little bit more. We need a little bit more into the early stages this week, and then I might be interested, right? You could see here, and I think I need to reset this to let's go with a 60-day, which is going to be a 3-month IV look back period. You got just a hair north of that 35 zone. I want to see 50 plus. I want to see ideally 65 plus to start selling puts over on Palantir. And I'd like to do it such that I'm protected by the bottom end of the balance range. And, protection goes in air quotes very loosely. There's nothing saying that it can't blow straight through support. But if I am a put seller, I'd at least like to be, 140s or below. Ideally, I'd like to be somewhere in here closer to 120 if the IV can pump those up high enough to make the bang worth my buck. Right? So it's been a little while since I've taken a short put position, but I'd be interested in doing it, noting that Palantir is starting to feel the wrath of some aggressive down days. Let's take a peek over at AMD. What's going on with AMD? Nice break out of this balance range, but to do what? Just get into the top end of this. I got to see it over the 50. I got to get something that looks like this. If it's going to be playable, semiconductors need to continue to rotate, meaning away from NVIDIA into other names, MUs, TSMs, the whole 9 yards. I get that they're different in their different respects and what they explicitly do, but AMD, probably the closest to NVIDIA as a chip designer, got to get over this 226.65. Speaking of designers, let me just take a look at ARM real quick. Yeah, I wouldn't touch this one with a 90-foot pole. I got the question over and over and over again. Why don't you like ARM? Why don't you like Marvel? Look at the charts. They look horrible, right? Look at this. You want to trade this? No, thank you. No, thank you whatsoever. AMD at least has, it's in the influence of your OpenAIs of the world. We're having the conversation at least. So anyways, tangent aside, let's keep going. Let's finish up on Robinhood. Nice hammer candle off the lows. I like the look below and fail. Can we get some kind of hold over 114? Can we get some kind of move up into the 20 SMA there? It is in a downtrend. It is explicitly in a downtrend at this point, right? But you kind of have this maybe trying to neutralize things. I think that the daily hammer is what I'm focused mostly on, and it was one of the only names that broke down hard and actually put a recovery effort on into the end of day rather than the opposite. It didn't break out in the morning and then fail in the afternoon. It did the opposite, right? Here's the hourly. You can kind of see breakdown in the morning, end of day recovery, and hold over that 114. So an oversold, undercut, and rally, look below and fail as we call it, over 114. I'd like to try to maybe navigate through some of these levels up above, but with respect to the idea, this is still technically a bear flag and you just broke down from it. Right? So the hammer shows me sellers not getting aggressive on the lows, maybe a little counter trend. Do we stage the next lower high and then get down here? That's certainly a possibility. All right, core list of companies complete. Let's get through our additional ideas. ADI, Analog Digital. Let's take a peek at what's going on with this high type flag. This isn't the brand new record highs. I haven't even marked up the chart, but what I'm pretty much looking at is a trend line break there, and or just a break up and over this into blue sky territories. 283.50s is going to be the top end. There's no level to reference above that, and you got to hold on to that Friday low and this route low at, let's call that 270.70 for the sake of being congruent with the sevens there. All right, so low cheat maybe up and over 277.85. That is a possible idea. Let's go dim and gray on that one. A little bit of real-time charting for you. If we get this, it sets it up. High or low, great. You're over this as a double bottom neckline on like the hourly perspective. And then, of course, bull flag breakout, blue sky territories, the whole 9 yards. If you fail this level, you know, I've got zero, zilch, nada, cero, however many languages you want to say it in. Do not come back to the show and say, I longed ADI and now it's under 270.70. There's zero interest in underneath 270.70. If you cannot hold this after the hammer that was produced on Friday, if you cannot break up and over this and set something up for a higher low and a potential break, I want nothing to do with it through this. Right? You could say thin structure retracement. If you want to go out on a limb and try to short it there, be my guest. I'm more interested in the high type flag. ADI, done. Let's go DHR. DHR, Danaher. I think this is in the newsletter last week. It is a slower mover, so just be aware of that. But nice ascending triangle, decent relative strength on the Friday session, holding the 20 SMA and a gap to close overhead. If you could do this, I'd be interested in DHR as a possible idea. Slow and steady wins the race over 232.50 into the gap close 246.85 with a tight stop likely under Friday's low, 20 SMA, whatever the breakout candle looks like, stop here, right? Something along those lines. DHR, not a bad name. I like the pattern. I like the structure. Primarily, the gap close overhead is what makes the target very interesting. Let's take a look at MS. We talked about MS more earlier on in the financial analysis, but look at these equal highs. Look at the higher lows coming in, the equal highs in shorter and shorter proximity of time. I think he's asking for some of this ahead of the earnings move. It could be a buy the rumor, sell the news type event, but great relative strength on Friday. Easy to identify flat top breakout. If we can get it, let's rock and roll MS. Financials, let's keep it going. Let's go KTOS, Kratos defense over here. I like this as a possible break of this multi-week range. If we can get up and over this 82.50s, let's make sure that's exactly what it needs to be. 82.50, round numbers only up here in the office, please. There we go. We've got a gap to close overhead, and that gap is at, we'll go 86.60 on KTOS. From there, I would look for potentially continuation up to drift towards the highs. Thematically relevant drones, right? Defense, all this stuff is probably, there's just a chance it opens on a gap up given the over the weekend news here. If you want more drone stuff, I'll just give you a quick run through and a quick little idea of how these lists get compiled. Ondas, DPro, there's KTOS, RCAT, and AVAV are some interesting names that you could continue to look at. So let's take that back to our sectors. And, we've got built out lists all over the place here. You want the metals? There's the metals, right? So on and so forth. But let's go back to our S&P sectors. Good. And let's go to the next trade idea, which is going to be on Reddit, RDDT. A lot of people talking about this one, I think for good reason. You can see that we've got this nice consolidation starting to break out on Friday. Again, the theme here is what I mentioned in the intro. I know this has been like I don't know how much time we've got on now. It was just like an hour and a half long video, maybe hour and 20 minutes, hour and 15 minutes. However long, remember back to what I said an hour and 15 minutes ago when I said, hey, there are some shining spots. There are some thematically relatively strong areas in the market. The market was down, but look at this Reddit. Reddit catching a little bit of a bid there into the end of the week on slightly higher volume than the two inside days prior. So if this can continue up and over like a 245.25, this breakdown open, and then the all-time high is really the target here on Reddit. So can we get in gear out of RDDT? up and over these highs. Not interested if it just falls back down and consolidates around the 20. We'll let it be. And super not interested if it gets back down to in here. It would get off the radar. Next up, we'll go with Oracle. Oracle is interesting because there was also some thematic strength over in data centers. And Oracle, although it's underneath the moving average stack, I like the confluence here. And again, just like DHR, it has that gap overhead to potentially close. This is not a trade where you just position in it early. Got to see the strength, got to see the momentum, got to see a nice day in the broad market overall. But this cup and handle, little break that looks like that, not a bad look. And again, some strength in data centers as we were coming into the close of the week. I'll give you this list too. Data center, here we go. Your IRENs of the world. I mean, it might not look impressive in terms of its location here, but I mean, it's up 8.4% on the week, right? Primarily driven by what happened on the Friday session. Look at your CoreWeave. CoreWeave up 7.39% on the day from Friday and 7.86% on the week. Really impressive, really great volume. Look at your NBIS, not quite as good as the others, but still nice gap and go in the upward direction. Oracle seems to be the laggard at this point after a substantial drawdown here. Is it time for it to play catch up over this? Not a guarantee, which is why I've sort of noted, make sure that this is getting confluence with the broad market. Make sure it's a bullish day. Make sure there's momentum, and we're not just blindly longing Oracle because we feel like it and the pattern looks okay, but there's no actual price action confirmation. All right, I do want to talk about the SpaceTheme last, and I do have a list for that too. Let's go space. There it is. And it's a pretty thin list so far, and I'm sure there's more names that you guys will explode with in the comments, but ASTS, not the greatest name in the list, but space is clearly hot. Again, I wanted to point out where there is thematic relevance, where there is green shoots in the market. The market had a down day, and look at some of these names. Up 12% ASTS on Friday. Rocket Lab, 7.59%. Sea-Doo, which is not really Sea-Doo like the jet ski, but Sea-Doo. Space Inc., up big time, 18.47%. Again, this is not a call to action to say, okay, buy this up here at 4.10, but this theme is clearly telling you that it's hot. It's thematically relevant, and these are the places that you have to start looking as and if the market, broad market, Mag 7 starts to get a little bit more sideways, a little bit more confused, a little bit, I don't know what I'm doing. Mag 7's higher. Some names are good. Some names are bad, right? If they're not following through. Time to explore and expand the horizons. I think Rocket Lab is one of the better looking names out here because this higher low is so firmly over the 20 SMA. I'd be curious to see if we could tighten up in here over 73 prior pivot high and make another break into blue sky territories. Not some sort of guarantee, that's a very optimistic way that this chart could develop, but it's something that I'm thinking about. The last hot theme, it's not even the last one. There's a number of them out there, but I will share this one as well. You had some crypto strength out there, but I wanted to go to, where is it? Not nuclear, but clean energy. Some really big moves over here. EOSC up about 10% into the end of last week. I mean, I think it's still a great spot for a lower high. Like this chart is not fixed magically because it's up 10%, almost 11 on Friday. But, if this goes look below and fail, balances here, reclaims the moving averages, and then goes, it could be a thematically relevant name to start trading. FLNC had a pretty stellar day, 13%. I mean, come on, this was probably a little bit cleaner. Nice high tight consolidation here at the 50 for a higher low here and here. Breaking out of that over the 20 looks pretty darn good, as does FSLR, right? This higher low off the 20 after shaking out a lot of people. This one was frustrating. I can't even tell you how many people I saw online thinking about, that come to mind, at least 5, if not maybe closer to 7 people getting shaken out for like good reason. I mean, kudos to them respecting their stops. But just a frustrating name that is now starting to go again. Is this clean energy solar going to be a theme into 26, right? This one, just look at like asking for the break, NXT, CISQ, right? What do we have here, right? So I think as we head into 26, things that will be important to watch will be these very specific niche themes. No longer is it just Mag 7 AI semiconductors are going to send everything to the moon. If you're going to be active as a trader, and the NASDAQ looks like this, you could micro scalp your way into an NQ fortune. And if you can do that, then all the power to you. I would like to, nothing but the best for you as a trader. But if you're someone who looks for momentum, if you're someone who looks for, what is the broad market doing? And then how can I adapt for a core list of company name? 2026, I don't want to say the core list is dead, but boy, oh boy, looking elsewhere has been a little bit of a better idea recently as compared to not, and just being oblivious of some of those themes. So that's what I've got for you in today's episode of the Weekly Watch List, the first one of 2026. I am so excited for 26. I'm a little bit optimistic that we can maybe resolve this monthly equilibrium and weekly equilibrium, but I'm not holding my breath. I'm excited for some of this thematic stuff to start playing a stronger role in the analysis, what's hot, what's not. We will not lose sights from trading simple, repeatable strategies on really highly liquid, well-respected companies. But if there's opportunity that's no-brainer in some up-and-coming themes, I think it's worth expanding the horizons just a little bit. We don't want to chase shiny objects too much, but we do want to consistently make some coin by trading what's moving and not just being, oh man, S&P isn't going anywhere. This market sucks. Well, just, what was the famous line? It's a bull market everywhere, or there's always a bull market somewhere. You just need to know where to look. So on that note, we will wind it down. Once again, if you want to take a stab at where crude oil is going to open up on Sunday night at 6 p.m., if you are within plus or minus 2 cents, there we go, that's what I want, then you will get maybe some sort of prize over on X. You have to comment over on X. It's just too many bots, spam, all sorts of nonsense on YouTube. It's kind of unfortunate, but it's just the reality of how it goes. So X account is linked down below. You can go find the tweet. If you comment on that tweet, the tweet says, I'll put it up on the screen now at the end of the video. I'll actually remember to put it up right now. That's the tweet. It says, to all newly minted oil experts, who's got the best guess? Who can tell me where crude is going to open on Sunday night? With that said, hopefully you had a fantastic 2025. Let's charge into 2026, full steam ahead. Get yourself a solid night's rest on Sunday. Markets open bright and early, 9:30 on Monday morning. First full trading week of 26. Catalysts in the pipeline and earnings the following week from JP Morgan and the likes of the big banks. I'm fired up for it. Hopefully you are too. Have yourself a green trading week. And as always, I will see you in the next one.